Let's bring in Ed Clissold. He's the Chief U.S. Strategist at Ned Davis Research. Ed, I can tell you look excited like I am. Is that because the value relationship to growth is finally taken off here? Some of these things are coming to fruition for the economy. What do you think?
This is something that we've been looking for a long time. A lot of people have been looking for this since last year, and it looks like it's finally happening. We're finally getting a breakout in value relative to growth. This is either, if you look at a chart, either the fourth or fifth time since last July that values tried to make this move, and it looks like it's breaking through. And it's a combination of a few different things. It has to do with the economy doing better. And interest rates rising. It has to do with the stock market gains moderating, which allows some defensive value sectors to do better. And it has to do with the growth sectors finally giving up leadership as the economy reopens.
So, Ed, this is where I think the context of that value growth relationship gets really important, right? Because the question people are asking right now is, okay, is this the blow-off move in yields? Is it the blow-off move in the rotation and the kind of end of this spurt like we've seen before? Or is it just beginning? And if we look at the chart and what you highlighted to us last time, I looked at this chart every day, but I didn't realize until you pointed out the simple line, the horizontal line, showing basically that we've had this type of technical support in this relative relationship between growth and value. And so the technical take as well, when that support breaks, it means more is coming. Is that what you're saying?
Yeah, so we haven't quite broken through, and there's still a chance that support holds once again. But if you start looking at the drivers, there's a real good shot that this is, in fact, the break. And the first and foremost has to be what's been driving everything the last year and a half, year plus, is COVID. As the economy reopens, investors are going to be looking for stocks benefit from the economy doing better, and those tend to be cyclical value stocks. That's going to be the biggest thing that drives that. So those mega cap growth names that benefited so much last year on a relative basis, you know, they're going to take a back seat, and that's going to be the biggest driver.
So when we think about this, Ed, here's the catch: is that kind of internal rotation might be good if you're in the specific stocks that benefit from this more cyclical environment we're looking at, or the ones that are on the right side of the rate sensitivity. But is there a potential to where we spin so fast in this rotation, Ed, that it doesn't really matter and investors just dump everything? Because today, that's kind of what's happening.
Yeah, so this is a relative relationship, right? And so if you're looking at portfolio, is it up or down? You know, if everything's down and value is down a little bit less, it's probably not so good. So that is an element here. But I think we're still in a cyclical bull market, so the trend is going to be up. But one of the things that has been hurting value relative to growth is that there's this whole defensive group of sectors that are value-oriented: utilities, staples, real estate. And so the market booming 75% since the March lows means those low beta sectors have been left behind. If this is a more mature bull market where the pace of gains is a lot less, those betas are going to work against value less. So if the cyclical sectors do well because the yield curve is steepening, but the defensive sectors aren't going to be hit as much by the market booming, that's a recipe for value doing better relative to growth.
Okay, so that's important, right? Is that this may take a while to kind of shake out. Ed, I mean, we can look at these charts and we can kind of think about this very logically, but right now we have bonds heading back towards the lows of the day, and those lows came after a spike in yields that was basically a flash crash. It looked like a fat finger on the chart. So it's hard to kind of talk about some of this sort of academic growth value when we've got what's happening on the intraday. So tell me, how should investors think about this? I mean, does this have the potential to really disrupt and just create fear if people are just going to keep bombing the treasury auctions?
Yeah, so what did Wall Street message boards decide that silver wasn't a big enough market? They want to go after the treasury market.
I'm wondering.
They can yeah. But I think if you're going to get major dislocations in the bond market, that is going to ripple through all other asset classes, including equities as well. But there is a bit of a balancing act here, where those going up have edge, but if they go quickly, then it's going to choke off the economic recovery, and then it's going to be a complete risk-off environment, which means stocks are going down, bond yields are going down. So we have to see how that balancing act plays out, and perhaps what happened a little bit earlier today was showing that yields cannot move up too quickly, otherwise it's going to cause a whole other chain reaction.
Ed, what about the stock-bond relationship? I know you study, obviously, the dividend and the earnings yield and how that relates to bonds. I know that we're getting close, basically, for the 10-year to offer an alternative to the dividend yield. But, I mean, nobody's really been buying stocks for dividends lately, have they? They've been buying them because they go up 20% every week. So how does that factor into this dynamic at all? Does the 10-year above the earnings yield draw in buyers at this point?
Well, and when talking about relative value, I think it's pretty interesting last year is, it's not just the dividend yield, it's the buyback yield, right? So you're looking at how much companies are buying back stock. Buybacks were put on hold last year for a lot of reasons, but mostly just conserve cash. I think buybacks are going to make a big comeback in 2021, and so that could be another supportive area for stocks. But if the big picture, stocks versus bonds, a 10-year yield at 150 probably means that stocks still look pretty good on a longer term basis.
Okay, Ed, at what point do you last point here, because we're having a little trouble with your connection, unfortunately, but when you just look at how this market has been very sentiment driven, another one of the charts that you often bring here is about the elevated sentiment, right? And when we are in those environments, sometimes it doesn't have to be a real clear reason, right? It's just the music kind of stops. What will you be looking at to see if the music has stopped?
So I didn't quite catch all of it, but I assume you're asking about sentiment. Our sentiment composites are really elevated. They've been that way for the last few months, really since about a week after the election. And if sentiment's been that optimistic for this long, it means the market's vulnerable to the next piece of bad news. In this case, it's come from the bond market, but really whatever it would have been would probably have been enough to knock the stock market down a peg or two.